When I calculate intrinsic value of a business, I look at it and say, what will come out of this business and when?
Buffett says, the three most important words in investing are margin of safety. Undoubtedly, the concept of a margin of safety remains a fundamental principle embraced by value investors throughout history and in the present. The greatest investors of our time remain true to this principle and achieve outstanding returns time and again. Value investors should certainly learn about the principles of the margin of safety and incorporate them into their investment strategies. However, a common problem is that many investors do not know how to calculate the intrinsic value of a company, which consequently prevents them from effectively applying it, even though it is relatively easy to do so. We will gain the essential skills to effectively assess the intrinsic value of any company. This skill will empower you to find the fair stock price of a specific company, while taking into account a suitable margin of safety. So, in order to discuss the crucial concept of the margin of safety, which plays a significant role in Warren Buffett's investing strategy and contributes to his continued success, it is essential to understand how to calculate the intrinsic value of a business. The intrinsic value represents the worth of the business, essentially reflecting its true value. Warren Buffett puts it as follows. The intrinsic value of any stock, bond, or business today is determined by the cash inflows and outflows discounted at an appropriate interest rate that can be expected to occur during the remaining life of the asset. The intrinsic value of an asset, or company, is determined by calculating the sum of the present values of all future cash flows. Put simply, to calculate intrinsic value, two things are necessary. One is the expected future cash flows generated by the company, and the other is how much these future cash flows are worth to you at the present time.
Well, intrinsic value is what is the number that if you were all-knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is. In other words, the only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about.
Let's assume there is only one owner of the company, you. There are no other investors, and the company belongs to you alone. Then all future earnings are available to you, called owner's earnings. And for the company you have invested in to create value for you, it must generate profits for you. And the more profit it generates, the more it is worth. Also interesting, only 5% of people who watch my videos are actually subscribed. So if you are included in the 95% of viewers who aren't subscribed yet, go ahead and reverse those numbers. It's completely free and helps out a ton. Lastly, feed a like to the algorithm. To calculate the owner's profit, we need to take a look at the cash flow statement. By taking the operating cash flow, also known as cash flow from operating activities, and subtracting the maintenance capital expenditure, we can determine the owner's profit. Now, the operating cash flow is the cash flow generated by a company's core business in a given period. On the other hand, maintenance capital expenditure refers to the expenditure required to keep the business up and running. The owner's earnings is the most accurate figure for these calculations. Unfortunately, though, companies are not required to disclose their maintenance capital expenditure. While there are exceptions, the majority of companies do not disclose this information. Therefore, many investors choose to use total capital expenditure instead. The item, purchase of property, plant, and equipment, in the statement of cash flows includes both maintenance investments and investments in the expansion of the business. To simplify the calculations, we will use the free cash flow. Although a more conservative approach, the free cash flow is also somewhat less accurate.
When you look at a bond, very easy to tell how much you're going to get back. It says it right on the bond. The cash flows aren't printed on a stock certificate. That's the job of the analyst, is to change that stock certificate, which represents an interest in the business, and change that into a bond and say, this is what I think it's going to pay out in the future.
Let's look at the process of calculating the intrinsic value of a business. In this example, we will focus on the acquisition of a lemonade stand. Now, to do this, we analyze the historical free cash flow of this lemonade stand over the last 10 years. To keep the example as simple and understandable as possible, we work with a constant historical growth rate of 10% of the free cash flow. Next, our approach involves taking the latest available free cash flow figure and applying its consistent growth rate, which has been observed at 10% annually. We will project this free cash flow by compounding it with a 10% growth rate over the course of 10 years into the future. Since the company is likely to stay in business after the 10-year period, we assume a terminal value for the period after the cash flows we projected. A quick and common way to estimate the terminal value is to multiply the earnings in the last year of the projection period by a multiplier. This also applies if we intend to sell the company again. For our lemonade stand, we assume a multiplier of 10. Following this, we assume that at the end of the 10th year, we will have the opportunity to sell the business for a value equivalent to 10 times its free cash flow. When we add all those numbers up, we get the value of the company to us, which is the cash flow we expect to receive in the future as owners. However, this calculation does not fully take into account that we intend to make the purchase at the present time and receive the cash flow only in the future. As a result, these cash flows are not as valuable to us because it will take a significant amount of time before we actually receive them. These cash flows are projected far into the future, and it is important to consider the time value of money.
If you buy Coca-Cola today, the question is, would you lay it out today to get what the Coca-Cola company is going to deliver to you over the next 200 or 300 years? The discount rate doesn't make much difference after as you get further out. And that is a question of how much cash they're going to give you. You're laying out cash now to get more cash back later on. And the question is how much are you going to get, when are you going to get it, and how sure are you? A bird in the hand is worth two in the bush. The question is, how sure are you that there are two in the bush, and how long do you have to wait to get them out? That's all there is to investing.
If given the choice of receiving $1 now or $1 in a year, someone acting rationally would always choose the $1 now. The reason is that this dollar can be used immediately to generate further income. By investing it, you can increase its value and earn additional money. Therefore, you should always prefer to get the money earlier. Applying this concept, we need to discount the company's future cash flows to determine their present value to us. If our goal is to achieve a 15% return on our investment, we need to use an annual discount rate of 15%, as this is consistent with our investment objectives. Additionally, we apply the discounting principle to the one-time cash flow we will receive from the sale of the business in 10 years at a value equal to 10 times the free cash flow. By discounting this cash flow, we include its present value in the calculation. After discounting all future cash flows, including the gain from sale, we get the present value of the entire investment. To obtain even more accurate results, we subtract the company's total debt from this value, since the debt must eventually be repaid. In return, however, we add the available cash, since this is part of the lemonade stand and is therefore available to us. Both are reported in the balance sheet of a company. The items cash and short-term marketable securities can be found under assets. Total debt can be found under liabilities and shareholders' equity. The current intrinsic value of the business, calculated by adding all the cash flows up, adding cash, and subtracting debt, is approximately $3,400. If we were to make the owners an offer of $3,400 for their store, we would most likely earn a 15% return by running the store, assuming free cash flow grows at an annual rate of 10%. Now, if the current owners insist on a higher price, say $5,000 for the business, our potential return would drop significantly. Conversely, if the owners are willing to sell the business fast and cheap and offer it to us for $2,000, our potential return would be much higher. However, at a constant rate of return of 15% per year, the intrinsic value of this company remains at $3,400. Now, the interesting part is, this is exactly what happens every day on the stock market. The stock market provides us with the prices of countless companies every day. By looking at the market capitalization of the companies, we can determine the current valuation of the entire company. At the same time, we can analyze the financial statements of these companies, calculate their intrinsic value, and then compare it to their current market capitalization. This comparison shows whether the company is trading at its intrinsic value, at a premium to its intrinsic value, or at a discount to its intrinsic value. Now, since in the real world you probably buy individual shares rather than the whole company, you have to divide the intrinsic value, which reflects the fair value for the whole company, by the number of outstanding shares. Afterwards, you can compare this newly calculated intrinsic value per share with the actual current share price of the company. However, it is important to acknowledge that any calculations we have made to estimate the intrinsic value are ultimately based on an educated guess of how much the cash flow of the business is likely to grow in the future. While we can reduce the risk that our estimates are incorrect by seeking companies with consistent growth and financial data, we should also be aware that unforeseen events and factors beyond our control can affect any company in the future. Therefore, we should approach investments with the understanding that there are uncertainties and variables that cannot be fully predicted or controlled. Imagine it's unusually cold and raining a lot, so lemonade is less in demand. Or a new juice bar opens next door and our sales go down by 50%. Even though these events seem unlikely, they remind us that we cannot rely on our estimates with absolute certainty. To manage this risk, it is important to include a margin of safety. Instead of buying a company at its calculated intrinsic value, we implement a buffer, a margin for error. This margin of safety leaves room for potential inaccuracies in our intrinsic value calculations, because we know that even small errors can significantly impact our returns. By providing ourselves with this buffer, we mitigate the risks associated with unforeseen events and uncertainties. Don't try and drive a 9,800-pound truck over a bridge that says its capacity is 10,000 pounds, but go down the road a little bit and find one that says, capacity, 15,000 pounds. Benjamin Graham says, "The function of the margin of safety is, in essence, that of rendering unnecessary an accurate estimate of the future." To incorporate a margin of safety, we reduce our calculated intrinsic value slightly. This adjustment allows us to create a buffer, providing protection in case our estimations prove to be incorrect. So if we calculated the intrinsic value of the lemonade stand to be $3,400, we might consider offering a price below that value, such as $2,000 or $2,500. The decision to buy depends on the store being offered at a price below its intrinsic value. However, an appropriate margin of safety is a somewhat subjective matter and varies based on individual preferences. Experienced investors who have a high degree of confidence in the predictability of future cash flows may opt for a margin of safety of 20 to 30%. In contrast, less experienced investors or investors dealing with riskier and less predictable businesses may aim for a larger margin of safety, such as 50%.
So if we buy something like See's Candy as a business or Coca-Cola as a stock, we don't think we need a huge margin of safety because we don't think we're going to be wrong about our assumptions in any material way. What we really want to do is buy a business that's a great business, which means a business is going to earn a high return on capital employed for a very long period of time and where we think the management will treat us right. We don't have to mark those down a lot when we find those factors. We'd love to find them when they're selling at 40 cents on the dollar, but we will buy those at much closer to a dollar on the dollar.
Ultimately, the choice of the appropriate margin of safety depends on your risk tolerance and your confidence in the company's performance. However, finding a 50% margin of safety can be quite a challenge, especially in the current market environment. As an investor, however, it's crucial to take a patient approach and wait for the right moment when the companies we analyze are offered by the market at a price well below their intrinsic value and provide the required margin of safety. Acquiring a company with a 50% margin of safety leaves considerable room for error in our future projections and still offers a substantial 15% annual return. By purchasing with a margin of safety, we mitigate a significant portion of the downside risk associated with investing in a company and ensure that we are purchasing shares at an advantageous price point. Let's take a look at this concept in practice. The diagram shows the daily fluctuating stock market price of a company and the intrinsic value calculated using the discounted cash flow method, which represents the actual value of the company for different points in time. We see that the price of the company approaches its intrinsic value over time. However, reaching the intrinsic value alone doesn't trigger our decision to buy. We still need a margin of safety to account for potential inaccuracies in our predictions and estimated intrinsic value. If the company's share price continues to fall and drops below a certain threshold, for example 30% below intrinsic value, it's time to strike. At that point, we invest in the company. However, it's crucial that you have done thorough research and analysis before this point. You need a comprehensive understanding of the company, including its competitive advantages. You should also have verified the capabilities of the management team and confirmed a solid balance sheet. With the ability to acquire stocks at a discounted price relative to their intrinsic value, we achieve a margin of safety that significantly mitigates our risk. This is the main reason why famous investors have continuously been successful over the years. They maintain their rationality, are not caught by emotions during price fluctuations, and patiently wait for opportunities to invest in exceptional companies at prices that provide a margin of safety. This way, they achieve substantial upside potential while minimizing the possible risks. And if you're now wondering what to watch next, have a look at this video on screen I handpicked for you. Anyway, thanks for watching. Like and subscribe.